Let's start accounting lesson 3, the accounting equation. This lesson will include number 1, the accounting equation, number 2, importance of accounting equation, number 3, components of accounting equation, number 4, 3 ways to write accounting equation, number 5, properties of accounting equation, number 6, use of accounting equation, example 1, and number 7, use of accounting equation, example 2. The accounting equation. Equation is assets is equal to liabilities plus capital. The accounting equation, also called the balance sheet equation, represents the relationship between the assets, liabilities, and owner's equity of a person or business. It is the foundation for the double entry bookkeeping system. For each transaction, the total debits equal the total credits is the thumb rule. Importance of accounting equation. Equation is assets is equal to liability plus capital. The accounting equation describes the relationship between the three components of the balance sheet: assets, liabilities, and owner's equity. All else being equal, a company's equity will increase when its assets increase, and vice versa. Adding liability will decrease equity, while reducing liabilities, such as by paying off the debts, will increase equity. These basic concepts are essentials to modern accounting methods. Components of accounting equation. Number 1, assets, number 2, liabilities, and number 3, capital. The three elements of the accounting equation are assets, liabilities, and capital are shareholders' equity. A company's total assets are equal to its liabilities plus its shareholder equity. The double entry bookkeeping system, which has been adopted globally, is designed to accurately reflect a company's total assets. 3 ways to write accounting equation. We can write the accounting equation as asset is equal to liability plus capital, or capital is equal to assets minus liabilities, or liabilities is equal to assets minus capital. Here capital denotes owner's equity or shareholders' equity. Properties of accounting equation. Accounting equation sets the foundation of double entry accounting and highlights the structure of the balance sheet. Double entry accounting is a system where every transaction affects both sides of the accounting equation. For every change to an asset account, there must be an equal change to a relative liability or capital or shareholders' equity account. Double entry bookkeeping requires that for each transaction an entry is made once for the item exchange and once for the form of settlement. Balance sheet actually is a balance between what belongs to the business and what do not belong to the business. That is, assets belongs to the business and liabilities and capital do not belong to the business. Use of accounting equation. Example 1. Mr. Bean starts a business. Here his assets are 0, liabilities are 0, and capital is 0. Transaction 1 occurs when Mr. Bean starts a business with initial capital or investment of $5,000 in cash and a table and share worth of $1,000. So the change in the equation will rise as assets is equal to cash 5,000 plus furniture 1,000 is equal to liabilities 0 plus capital 6,000. Use of accounting equation. Example 2. The current situation of the balance sheet of Mrs. Bean is assets equal to cash $5,000, furniture $1,000, and liabilities are 0. Capital is equal to $6,000. Transaction 2 occurs when Mrs. Bean purchase inventory of $5,000 from Mrs. T, paying cash of $2,000 and credit of $3,000 payable after 3 months. After recording the transaction 2, the balance sheet of Mrs. Bean will be assets equal to cash 3,000, inventory 5,000, and furniture 1,000. Liabilities are 3,000 and capital remains 6,000. So both sides of the equation will be equal with an amount of $9,000. Our next guide of accounting will be lesson number 4, General Journal. So keep on connected.